Hey, welcome back. Today we are going to talk about one interesting question that comes up quite often. How much can I lose? So, how much more can I lose if I buy a company that has fallen sharply in the past? Let's say it was 400 a year back, now it's 200, 250. How much more can it fall? That's a question, interesting question. And there's another question. The stock has risen very sharply in the last few months or maybe a year, and is buying a stock that has fallen sharply safer than such a stock which has risen very sharply in the recent past? These two questions are very interesting, something that comes up too often, and we will look at it in depth in this video. It will rise or fall based on the underlying business. The price actually correlates with the business that it's based on. Predicting past performance in terms of price and looking at historic stock price charts is futile to predict future performance of a business. The business drives the stock price and not the other way around for most good stocks. There are exceptions which are beyond value investing. They can be driven by momentum, short-term fluctuations. Those are beyond the scope of this discussion. So focusing back on value investing, we will only discuss about how the price is influenced by the performance of the company. And that is one of the safest ways to invest, because you're beating 99% of investors. 99% of investors don't look at how the performance of a business is going to be in the future. They only look at the stock price, the momentum, and other aspects which really don't control the outcome. The price of a stock goes up or down because the demand and supply changes every day, and that drives the price. That's very common in the short term, and in the very short term it's pretty much what controls the price. It could also be because of a news, or I can call it noise sometimes. That's possible. It can happen if there's a change in fundamentals or the business itself, and that is something that's important to note. These three aspects control price of a stock in broader terms. Now, we don't know whether a stock is going to be 10 times, 100 times the current price that we are going to buy at. We really don't know that. So, the ultimate goal here is to find the possibility of a business growth, the earnings growth, and the cash flow the company can generate in the subsequent years. And then we should be able to determine whether the stock is good or bad in terms of valuation. Can we buy it today, or should we wait for tomorrow, or should we avoid it completely because there is no possibility of this company growing its business and earning potential? So that is what we will discuss in detail in other videos. But today I will answer one of the questions that we still have remaining. So if you buy a common stock, one for rupees 10 and another for 100 rupees, and let's assume both of them go to zero. So does it matter at what price you bought these stocks? Really, no. So let's say the one stock rose from maybe 5 rupees to 10 rupees, or fell from 20 rupees to 10 rupees. Does it really matter? So ultimately, one must be looking at the future earning potential, future earnings, and think about it as if how much would you pay in the future to buy the same stock. Now, bring it down to today's value with discounting. We will talk about it in another video. You can go for NPV, the video that will be in depth discussing about it. So once we know the future value that we would be willing to pay for the stock, we can bring it back to today's value. And if this value is more or greater than the current price that it's quoting, then we will be happy to buy that stock. If the current price is significantly higher than the value that we attribute to this business, then all we have to do is wait. And people who wait will be rewarded. If the price is exorbitant, then it has to come down eventually, as long as you're able to value the company accurately. So that brings us to one important aspect. 90% of the effort required in investing is to understand the business, the industry, and see how much growth is possible. So being an expert in a business or industry gives us the ability to understand the difference between probability and possibility. So anything is possible, but the probability of something occurring with a high ratio gives us confidence to invest money. So 90% of the work is already done when you have the expertise to understand future growth prospects of a particular company. The remaining 10% would be vital too, because you need margin of safety. When you make an investment, you have a lot of variables. Even for the management to understand what is going to happen, they need a lot of inputs. So one needs to understand margin of safety. How much amount of deviation is possible from the probable outcome that you desire. If you're not certain, your margin of error is high. So your margin for safety should go up as well. So that is why being an expert gives you enough confidence to work with adequate margin of safety and with minimal margin of error. All you can do is reduce the error rate, but you cannot avoid making mistakes because the variables are not controlled by you. The variables are indeed changing by the hour, by the minute, and hence nobody can predict you, not even the management. If you understand that and make the right choice, your investment will yield a great value. The price and earnings are very similar in the long run. But in the short term, you can see that there is no real correlation. Everything can change the price. Anything as simple as news or a noise can make the price go up or down. So, in the long run, the past performance does not matter in terms of the price chart. The past performance of the business does matter to some extent, but not in the long run. In the long run, what matters is the earnings, the cash, the growth in the business. The sustainable growth rate. How much can you grow your sales at the right margin without taking debt or taking minimal debt and still not bleeding on the other side? So these aspects drive valuation. These aspects drive the future price of a stock. And that is what we are interested in. We're not interested in how much the company produced in terms of stock price in the last month or last year, or how much did it fall in the last few weeks or few months. Those are noise and they should be avoided. Thank you.